Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Report and Banking on Profits newsletter, coming to you from down here in Central Florida, where the weather has finally turned back in our favor and we're out of those mid 60s chilly period that we've been experiencing, back up into the lovely 80-degree area. And that would explain really why this video is coming to you on Monday and not over the weekend like I usually do. It was just too nice out. We got out and about and enjoyed the sunshine and just generally had a good time once we got the basic stuff we had to get done over the weekend. Very enjoyable weekend. So, kind of a flattish week in the stock market last week. The S&P 500 was down 0.26%. That brings the month return though to a very healthy 5.26%, as all the concerns of January from geopolitical and economic events have faded into the rearview mirror as traders begin to position for the anticipation that, in fact, as David Rubenstein pointed out at the Super Return Conference last week in Berlin, it's probably going to be fall at the soonest that the Fed can really think about doing anything with raising interest rates. He pointed out that if they actually did raise rates, the dollar could get even stronger, and ultimately that's not going to be real good for us in the long run. So look for the Fed now to, there's still some talk of June. I personally don't see it. I think it'll be later in the year, maybe even next year, before the economy is actually healthy enough for them to really meaningfully raise interest rates. Traders are focused on that, so we had just a fantastic February in the markets. The Euro World URTH index was up 0.44% last week. Bringing that up to a solid 5.4% February. So, very nice month all around the world. And last week, our little banks, as represented by the QABA Community Bank ETF, they were basically flat for the week, but they were the leader for the month with a solid 7% gain. Now, obviously, this past weekend was a big weekend in value investing land as Warren Buffett released his annual shareholder letter. Now, I know some folks all over the world who they're there at 8 o'clock p.m. Eastern Standard Time. Friends on the West Coast, they get up early so that they can catch this thing as it hits the wire at 5 in the morning. I read the letter, guys. Every year I get around to reading it, and I think I finally got to it sometime late Saturday after I'd done all my usual stuff and been out for several long walks with the wife and the dog and enjoyed the day, as I said. Here's the thing. First off, the letter contains no actionable information. Everything that he reveals about his stock portfolio was already revealed in his 13F filing, so there's no new information. Here's the other thing to all my Buffett files out there. You're not Warren. You can't invest like Warren and Charlie Munger do. Warren and Charlie have, I think the number was $85 billion or some ridiculous number of free insurance float to work with to invest to magnify their returns. That's a lot of free leverage. You and I will never have access to that. Likewise, you and I cannot just go out and buy entire companies the way that Warren does for the most part. And most importantly, even in the equity side of things, the publicly traded equity, most of what Warren has bought in recent years has consisted of special deals, much like the convertible security deals he cut back in 2008 and 2009 with Bank of America and Goldman Sachs, where he came in, invested cash in these banks to keep them going as the crisis mounted, and in return he's received a very generous convertible preferred, paying a very high rate of return until he chose to actually convert the securities. They're not going to call us with that deal. We don't have $5 billion of ready money to throw into that type of bailout situation. So we can learn from Buffett's principles and ideas, and you learn a lot of good things from Warren Buffett. He's clearly one of the best investors and businessmen of our time, or any other time for that matter. But you're not going to be Warren in this lifetime if you're not already on a really good start. You're probably not going to make it. So what we have to take away from the letter is not specific thoughts or ideas that we can invest in, but we need to learn from what Warren Buffett is actually saying. And here's my 3 key takeaways from the Warren Buffett letter this past weekend. First off, Warren and Charlie in his follow-up section both made mention of the fact that it pays to have cash around to take advantage of what Charlie Munger called unusual opportunities, vis-a-vis 2008-2009, when Berkshire Hathaway invested almost $16 billion into the equity markets, drawing down temporarily their cash hoard to take advantage of the beaten up prices as a result of the credit crisis. I suspect that along with me, they're somewhat fans of Mr. Womack and Hetty Green, because that's certainly their approach to buying stocks as well. So it doesn't hurt to have cash around. I think even the individual investor should always have some cash to take advantage of unusual opportunities created by a rapidly declining stock market. And of course, now we're almost 6 years into an extended rise in the market, so we have lots of cash, about 50% in the value portfolio, simply because prices are extended. We've been selling stocks that reach fair value, and there's really nowhere to put the cash at this point in time. So we have cash, we sit back, and we wait for an inventory creation event, just like Warren Buffett and Charlie Munger would be doing were they running an all-equity portfolio at this point in time. The other thing that Mr. Buffett said is one of the biggest mistakes most investors make is they think in days, weeks, and months, and not years and decades when it comes to their stock holdings. There's no need, if you buy stocks right, there's no need to be in a rush to sell. And this is a marathon, folks, not a sprint. We're trying to build wealth over time and let the compounding effect work for us, just as it did for Berkshire Hathaway, although probably in a somewhat lesser degree of magnitude, as Buffett and Munger have been able to pull off over the last 60 years. So, by the way, this is the 50th anniversary of the Berkshire Hathaway shareholder letter. The first years of his career, as you may recall, were in the Buffett partnership, and then it was converted to Berkshire Hathaway shares when he bought the textile mill up in New England many, many years ago. So the other big takeaway was Warren said in the letter that in absolute and relative terms, the 1950s were the period of time where he enjoyed the highest returns, and he was investing almost exclusively in asset-based bargain like net current asset value stocks and stocks trading at a tremendous discount to book value. Those were the highest returns he ever earned in his entire lifetime. However, what he found is as returns grew, money piled up, it's not scalable. Okay, you can do it with a few $1 million. You can't do it with a few $1 billion. Warren's goals and dreams were much bigger than a few $1 million, and that's worked out extraordinarily well for him. He's one of the wealthiest men in the world. Now, I don't have those sorts of aspirations. I was about 40 years old when I figured out that I really did not want to be the biggest and the brightest and the best in the history of the world. That what I wanted to be was comfortable, content, and happy, and let the power of compounding work for me so that I could live my life in the manner in which I chose. And, I place things like family and books and baseball above, running a multi-billion-dollar fund. I do not now. I have no aspirations to do so. And if nominated, I probably would not serve. I like my life the way it is just fine. Thank you very much. So small situations like net current asset values, there's a few around. I think we have 4 or 5 in the portfolio, if memory serves. I'd have to go back and check. And they're off to a tremendous start in 2015, by the way. Most of them up double digits already this year. So if we can find those, I buy them. And certainly we're involved in the least scalable of all sectors all the time, and that's community banks. These little tiny banks, you could never run a multi-billion-dollar fund or hedge fund investing in these things. They're simply too small. They're too illiquid. And that's one of the reasons they've worked so well for me over my career and investing lifetime. So those are my 3 real takeaways: cash, time, and size. And once again, time and size, the 2 biggest advantages that we have as an individual investor. And every day, the bulk of individual investors go out and they give them away without getting anything in return. So cash, time, and size, keep those 3 in mind. That's not just for me. That's from Mr. Buffett himself in the shareholder letter released this weekend. Now, we had another, let's say, less happy event during the week. Irving, a legendary value investor, passed away at 109 years old. Remarkably, as recently as last year, he was still going into work at the investment firm he founded back in 1978, Com Brothers, 3 or 4 days a week. Finding cheap stocks was his passion in life, and he simply did not want to give it up, so off to work he went. I hope I live that long. I hope I still have that attitude and am still searching for cheap stocks at 108 years old. Mr. Kahn was as you may recall, he was actually a teaching assistant for Ben Graham. He's one of the very last investors, besides Charles Brandeis and Warren Buffett, with a direct connection to Ben Graham and the founding of value investing. In fact, Mr. Kahn compiled notes and worked on both security analysis and the original edition of The Intelligent Investor. All of his life, he stuck to searching for stocks pretty much based on price to book value, just as Ben Graham taught him. And he left us just some great quotes and information that we can use to guide our own investment careers. Just last year, he gave an interview at 108 to the Financial Times, and he said that he takes it slow and steady. He thinks about what stocks will return over the next 4 or 5 years, and if the situation doesn't change, and his argument for why to buy the stock doesn't change, he should be willing to add more at lower prices. And of course, that's something that I preach all the time. If the numbers don't change, buy more. If the numbers do change, well, then you have to reevaluate the situation. But all too often, we see the emotional morass that is the stock market drag stocks down 40, 50, and 60% without the underlying numbers of the business ever really changing. When that happens, we buy more, and that's almost always, I'm going to say 90% of the time, has worked out in my favor. He also said something that I preach all the time, and it's the thing I probably take the most flack for in my investing career. If the market is overpriced, be patient. You have to be willing to wait. You can't just chase stocks. You don't have to play just because the casino is open. If blue chips are trading, as they are right now, almost across the board, at 1.5 to 2 times any rational valuation level that could be explained with math instead of a story, then you've got to sit back and wait. And much like we're doing, you're going to end up having a ton of cash in the portfolio. We added a couple of stocks to the deep value portfolio last week, but they were small positions. They were deeply undervalued stocks, and they were relatively small companies that are not on most people's radar screen. Even given that, we're still a little over 50% in cash at this point in time, and maybe raising more because some of our stocks are, along with the market, off to a flying start in 2015 and are approaching their fair value levels where we're going to start thinking about trimming the position back a bit. He also said something that I like, and I can't decide if I want to get it stitched onto a nice pillow or just have it done as a tattoo. And he said, never buy popular stocks except maybe in a depression. That is the best advice I can ever give you. When you look across the screen at some of the really popular stocks trading at 75, 80, Netflix is trading at 109 times earnings right now. There is no rational way to project a growth rate forward that justifies that valuation. However, back in 2009, when you looked around, you could buy a lot of wildly popular stocks for right around book value and single-digit multiples of earnings. So if you're patient and you wait and you get maybe not a depression, just a severe sell-off in the stock market, you can buy these popular stocks at much better valuations. Maybe you just avoid them your entire career, like some folks, including Irving did throughout his very, very long career on Wall Street. He also said learning is essential, that he loved to read, and that's why investing was the perfect career for him. And right up until the day he died, he focused on learning and reading and expanding the knowledge that he had about markets, life. He was particularly fond of science, apparently, and read a lot of science-related material. Always be learning, always be reading. It's not just part of being an investor, it's part of being a person. Whether you're reading to gain information and knowledge, or you're just reading for your own entertainment. I think that reading of all sorts provides knowledge and adds just an enormous amount to your life. So always be reading, always be learning. Make that the focus of your life instead of just binge watching too many TV programs and mindless activity of that nature. So always be learning. It's one of the better lessons that Mr. Kahn has to give us. And he also said never, ever, if you're a real investor, feel bearish. Because even when markets are plunging and everybody around you is scared and panicking and very bearish indeed, that's a time to be buying stocks, and you should be pretty excited about that. So never be bearish on markets or on life, according to Irving Kahn, and I completely agree with him. So when he died, his largest positions were British Petroleum, Patterson UTI, and BlackBerry, all trading at or below book value at this point in time. So BlackBerry, he's one of the few investors that has stepped up and really amassed a large position in BlackBerry. So that works out. Con Brothers clients are going to be some extremely happy individuals over the next several years. Now, the biggest sector in Mr. Khan's fund last week was financial services, including several small banks that fit right into the trade of the decade portfolio. He may have been 109, but he was still looking forward to the high potential returns that are available in the community bank space right now, and so should you. Anyway, it's 82 down here in Florida today. Beautiful, sunny. Gonna stay this way all the way into next week, and Wednesday, I'm getting on a plane. I'm flying back to Baltimore for my daughter's wedding next weekend. And I'm going to be greeted Thursday morning when I arise by temperatures that are going to be a high of 28 degrees. And it's going to be snowing. I haven't seen snow except on TV since we left Maryland a few years ago to come down here. And I have to tell you that I'm not particularly looking forward to it. One upside, spring training games do start tomorrow. The Orioles will be playing the Tigers, and I will have my little MLB TV prescription on my phone with me, and I'll be able to listen to those games either on the phone or on the local radio up in Baltimore. If I'm lucky, maybe, just maybe, one of them will be on TV, and I can kick back at the hotel and catch a couple of Orioles games during the week. Given the schedule that the Bridezilla that used to be my daughter gave me when I talked to her the other night. Not sure I'll get a lot of time to do that, but there's always hope. So anyway, guys, that's it for this week. Subscribers, please note that I am going to be off the radar screen through the weekend. If anything critical, important happens, I will, of course, get you an update right away, but there will probably be no regularly scheduled updates this Friday. I'll be busy doing wedding rehearsal and other silly stuff of that nature. Really tried to get them on a little lope, but they would have no part of it. So anyway, this is Tim Melvin from down here in sunny Florida. You guys have a great week. I'll be in Maryland freezing and missing Florida, but hopefully it'll be a very profitable and fun week for all of us. And I'll be back to talk to you guys sometime next week. Thanks for listening.